Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Reliance Nippon Asset Management sells encumbered shares of Yes Bank in the open market, bringing down Rana Kapoor's stake to below 1% in the bank. Mahindra Group and Ford announce a joint venture for India and other emerging markets. The Ministry of Corporate Affairs will begin investigating into HDIL's books of accounts after PMC Bank says the real estate builder failed to repay dues, leading to its collapse. GST collections for the month of August fall to 19-month lows at 91,916 crores. And really, to my mind, that was the big news of Tuesday evening post-market hours, wherein GST collection showed the number that they did. Anyways, we'll get to that, all of that in a bit. First, the trade setup, and the world markets didn't look a very happy place in trade yesterday. Actually, yesterday we were shut, so yesterday and day before, both the days, the Dow is corrected. 2 days on a trot now, and it's been a very rough start to the current quarter, which is the October, November, December quarter for the US markets. Frankly, with the kind of falls that we've seen in the last couple of days, if you just look at the technical parlance, now the US markets and the S&P 500, or even the Dow for that matter, but the S&P 500 is now trading sub key moving averages. And if indeed this fall were to continue, then you probably have, based on technical parlance, people believing that there could be more pain in store for the US market. So just look at that. It's back down on the 50-day moving average on the bearish momentum, and it'll be very crucial to see what happens in the day today or over the course of the next couple of days as well for the US markets. It's rubbing off on Asia as well. Nikkei is showing signs of severe pullback, 2% down for the Nikkei at 432 odd points. The other markets, Hang Seng about 141 odd points, half a odd percent. And the SGX Nifty, while it's not showing a deep gash as yet, you never know what could happen. Actually, both the days that we've seen, while the start would have been okay, it's in the second half of trade that we've corrected. I fear, this is my personal belief, I fear that this may not be the right indication of what our markets could do. We may actually have a start which is lower than what the SGX is indicating. By the way, keep in mind the impact of the weak US data, and both the macroeconomic data indicators that came out from the US for the month of September were not the most positive. Manufacturing and hiring both were lower, and that's showing in the way the other commodities are doing as well. So crude oil has fallen. Gold has risen naturally, so you would say, on account of this weak data. You saw the pullback because people would believe that the demand would get weakened. So both NYMEX and Brent crude came off. Gold, on the other hand, because of this risk off that you would believe that the US markets and the world markets could show, actually went up. So this is what crude has done. Both Brent and NYMEX down. Gold has actually moved up in trade. Well, actually, first, let's put some perspective into the world markets first, and we'll get in Peter Cardio to join us in just moments from now to talk about all of that. Keep in mind, with a couple of other factors that have also played out in the sense that most people now believe that the US tariffs are now set to hit Europe as well. The WTO dispute has been in favor of the US, and therefore that will happen. This conversation between US and China with regards to the capital wars is not all that pleasant too, and it's been a very rough start to the US market. So there's very little solace on the global front for our markets or markets at large, and which is something that should bother most investors or near-term traders at least. Frankly, if you look at our markets as well, I mean, I'll get to stocks in a bit, but just the trade setup, it doesn't look all that positive. Peter Cardio of Spartan Capital Securities joins us right now on the phone line to talk about the US data and the kind of start that we've had for the US markets. Peter, good morning from Mumbai. Thanks for joining in to BloombergQuint. What's your sense? This rough start that we've seen the last couple of days, the data is not too positive either, and there is no solace on the trade front. Do you reckon that the world markets are in for some more pullback over the course of the next few days?
I think so. And of course, a lot depends on the U.S. macro news. And tomorrow and Friday, we have two pieces of major economic news. Today, we'll be looking at the ISM non-manufacturing sector, and if that should slip below 50 or move towards 50, that would obviously be a negative, and I think the markets would continue to slide on that news. And then, of course, on Friday, we have the unemployment outlook, and we have labor market reporting somewhere between 150 and 155,000 new jobs. And of course, if that number should be weaker than that, then it could confirm what we saw with the ADP numbers, where we saw the private sector adding a mere 135,000. In itself, that number was not that bad, but it's certainly not within the trend area that we've been experiencing, and it did signal a top in the labor market. So the macro news continues to weaken here in the States, and of course not only here in the States, but abroad as well. And so the market is beginning to now realize that the slowdown is continuing, and if it should continue, that we could be headed for recession.
And would you reckon that therefore this sub 50-day moving average move on the S&P could actually worsen and we could have a drawdown of an X percentage? What's your understanding, or what's your take on how much lower can we go in this current downtick?
Well, from a technical perspective, if we were to test the 2875 on the S&P 500, and we were to breach that, I think we could see the S&P slip down to 2800 and possibly even a bit lower. Again, there are two main fear factors. One, the impact of the trade war, and of course, the reality that the slowdown is for real.
Yeah, and the reason why I'm sticking to levels right now, Peter, is because we've discussed fundamentals ad nauseum for the last so many days. It's just important to get a perspective from you on how do you expect the U.S. markets to do in the near term. But thank you so much for taking the time out and staying up for us all the way from New York. Peter Cardillo of Spartan Capital on the phone line. Well, and it was important to get that perspective as to what do experts believe the U.S. markets to do, because it's been such a rough start for those markets. Now, as a result of that, of course, the world markets haven't looked a very happy place either. Our markets. I think the more important determinant for our markets and what they could do is what's happening to banks and the bank nifty. And frankly, if you look at the OI positions, both the 29,000 put and the 29,500 calls, which hold such significant OI that you would want to presume that in between those levels, we are sub that on the spot at 28725 for the Nifty Bank, but you would presume that those are the levels which the markets will pay heed to, and maybe there could be some range-bound trade. If not, then we could have a substantial pullback on the Bank Nifty, which could impact the basic markets as well and the sentiment thereof. FIs continue to sell. We've seen 2 or 3 very high volume days. I think volumes in Tuesday's session were northwards of 45,000 crores on the cash spot market, and FIs were sellers to the tune of 1,299 odd crores. Yes, DI is compensated, but the foreigners continue to flee, and that should worry as well. So market's not looking in a very healthy spot. Very quickly, 2 or 3 stocks that I believe are very important. Yes Bank, and let's wait and watch if there is a different trade pattern to the Yes Bank. I'll talk about this in detail, but keep in mind the fall in the share price was triggered by invocation of the promoter group pledge, and the entire pledge stands extinguished after this latest sale. So maybe, just maybe, there's some light at the end of the tunnel for Yes Bank stock. Let's wait and watch if that plays out today. Mahindra & Mahindra to acquire 15% stake in the Ford Motors arm and form a JV. They're going to invest about 657 crores and have committed to invest up to 1,400 crores as well. And Interglobe Aviation, well, while the stock is doing what it is doing and is doing extremely well, there's fresh news that the promoters, which is the Interglobe Enterprises and Rahul Bhatia, have submitted a request for arbitration in the London court against partner Rakesh Gangwal. So, the board meeting, we have said that, partners are looking like resolving issues. The actions don't seem to suggest that. Let's wait and watch what happens to the stock today. However, let's tell you what's lined up on First Word today. Collection of the top editorial stories that we believe we should bring to you. Reliance Nippon invoking pledge shares was just one of the many reasons why Yes Bank's been under pressure of late. I take you through the factors. The PMC debacle has prompted the MCA to look into HDIL's accounts. Nikunj gets us the details. External benchmarking of floating loans has created a divide between public and private sector banks. Vishwanath Nair takes us through their rates. And then Nikki Johnson to tell us why the rains have taken a toll on Coal India. And we wrap up First Word with Sharad Dubey, who tells us why Godrej Properties has managed to beat its peers for the last few years. Well, Yes Bank, clearly one of the most important stocks. It fell about 22% on Tuesday due to the forced sale of 100 million shares in the open market. Rana trustees sold Rana Kapoor's pledged stake in Yes Bank, according to a statement from the lender. The entire pledged shares now stand extinguished after the latest sale. But this is the third such sale of promoter stake in Yes Bank. Rana Kapoor's privately held entities, Morgan Credits, sold about 2.3% stake, and Yes Capital offloaded about 1.82% stake in September. Rana Kapoor's stake now in Yes Bank stands below 1%. But even before all of that, exposure to risky assets, rising bad loans, and the resultant need for capital have been weighing down on Yes Bank shares. Take a look at some market statistics that I have for you. Now, as a result of what's happened in Tuesday's trade as well, Yes Bank fell for the fifth straight session, which is the longest falling streak for Yes Bank since the month of February, and it's back to August 2009 levels. That's how far the Yes Bank stock price now dates back to in terms of the kind of fall that we've seen. Well, it's now, as a result of which, the fall that we've seen, it's completed, or this is a 7th straight month of declines that we are in for the stock of Yes Bank. So it shows that it's not just what's happened very, very recently, but for the past few months, the stock has been under pressure and it just is not able to get out of that spiral downwards. In fact, if you look at stocks with a market cap of over 500 crores, just 500 crores, not substantial market cap, but over 500 crores, which includes a lot of small caps as well, Yes Bank over the last 30 days is amongst the top losers with losses of 55%. Look at what it has for companies: Suzlon, Den, Coffee Day, and Enables Housing. None of the stocks which would inspire too much of confidence, but Yes tops those charts. And the kind of fall that we had in Friday's session, which was amongst the steepest that we've seen in a really long time, was accompanied by the highest ever volumes seen by Yes Bank in its life. And this tells you a statistic. Of course, it was pledged shares which got invoked, and naturally you'll have this, but still it's a statistic that you got to keep in mind. Now, you might think that, I've compared Yes Bank with companies over 500 crores and how it's been the steepest fall over the last 30 days. But even amongst banks, if you just look at the 20-day average volumes, the end of the day volume, and the percentage of offload delivery, it's volatile amongst all the banks which are themselves very, very volatile. You just look at the 20-day average volumes, substantially high, the end of the traded volume, substantially high. And most of this is not delivered, despite the fact that a lot of these were encumbered shares which were sold. The delivery volumes stay at a measly 17.86%. So it's had a very rough ride. It's been the biggest drag on the Nifty as well, YTD. If you just look at the points contribution, yes, there are other stocks which have fallen. We've seen a lot of commodity names come off, but the biggest drag on the Nifty has been Yes Bank, and this is despite its measly weightage on the Nifty. It's been the biggest drag. That just shows you the kind of fall that Yes Bank has shown, really. And yeah, for a while now, it's been trading sub the 50, 100, and the 200-day moving averages, and the fall in Tuesday's session does it no favor. The only question that I leave you with is that with the extinguishing of all the pledged shares, could there be a trading bounce that could come in? Because the selling pressure would ebb today quite significantly, at least on the fundamental side. That's something that you got to monitor if you're looking to trade Yes Bank. Moving on, the Ministry of Corporate Affairs is looking into the books of HDIL. This is after loans given to the company brought down the Punjab and Maharashtra Cooperative Bank down. Nikunj Ohri has more details in this report.
The Ministry of Corporate Affairs is probing books of accounts of HDIL Limited after the loans given to the company led to the fallout of Punjab and Maharashtra Cooperative Bank. The Regional Office of Ministry of Corporate Affairs is examining regulatory filings, financial statements and related party transactions of HDIL Limited, and a report on the findings of the same will be submitted to MCA Secretary Mr. Inchetti Srinivas in about 2 months. The probe has been initiated after the Reserve Bank of India found that PMC Bank had an exposure, had a total exposure of about 73% to HDIL Limited, and loans advanced to HDIL Limited helped the company in delaying insolvency proceedings against the company. On Monday, Economic Offences Wing of the Mumbai Police has also registered an FIR against officials of PMC Bank and HDIL Limited.
Well, not surprising, and this one is not going down well either. Moving on, banks have had to shift to a new floating loan regime from the 1st of October. The rates are linked to external benchmarks, thereby changing the interest rate in some cases. So which banks have actually lowered the rates substantially? Vishwanath Nair has the answer.
After a push from the Finance Minister Nirmala Sitharaman, the Reserve Bank of India last month had said that all banks must issue fresh retail and MSME loans starting October 1 with interest rates linked to an external benchmark. Now, banks had all sorts of options, but a majority of the banks who have actually announced these external benchmark linked products have chosen the repo rate as that external benchmark. Now that October 1 has come and passed, let's try and get a sense of where each bank stands. As far as our assessment of these banks goes, we have looked at what happens with the home loan segment, because that is primarily where most lenders and most borrowers feel the difference in interest rates. So to get a sense of where these banks stand, let's start with State Bank of India, the largest lender in the country. And according to what State Bank of India has already disclosed, for loans up to 30 lakh, the previous interest rate, which was linked to the MCLR, was priced at about 8.15% annually. But under the new effective rate, which is the external benchmarking rate, that rate has come up to about 8.2%. That's not much of a difference from the previous rate. It's only about 5 basis points, which actually makes no difference to the customers. But how did the SBI come to that rate? That is, it broke up its interest rate into 3 parts. First is the repo rate, which is the external benchmark, 5.4%. Over and above that, SBI added about a 265 basis point worth of spread, which is essentially calculating its operating costs as well as some of the other administrative costs that may be linked to a loan, as well as about a 15 basis point markup, which is linked to the credit risk involved in that loan. So depending on the customer's risk profile, that 15 basis points will change, will essentially come down for better rated customers. Now, let's look at some of the other large lenders in the system. Firstly, with respect to Bank of Baroda, the MCLR rate was about 8.4 to 8.5% for a loan up to 75 lakh. Now, that has reduced or somewhat compared to about 8.35 to 9.35%. Essentially, that 9.35% is coming in because Bank of Baroda has introduced a 100 basis points credit risk premium. So that will change, of course, depending on the credit score of the customer. Similarly, for Bank of India, the rate has gone down from 8.45 to 8.65 to 8.3 to 8.65. So that is a clear reduction of about 15 basis points on the lower end of the spectrum. However, that 8.65% still stays. Here again, they have introduced a credit risk premium of 25 to 40 basis points. That is a range that the bank has given depending on the customer's credit profile. Essentially, 25 basis point works for customers who have a credit score of 760 and above, and then it just keeps coming up depending on the credit score. Let's look at some of the other public sector banks in the system. Firstly, that's Union Bank of India. Here again, between 30 and 75 lakh, essentially loans below 30 lakh, the bank has said it will charge 11.4% fixed rate. But for loans above that value, they have introduced an external benchmark. There again, the effective lending rate has come down from 8.8% to 8.3%. So that's a 50 basis point reduction for Union Bank of India, the higher end of the spectrum. Similarly, for Canara Bank, now the Canara Bank, when it released its statement to the stock exchanges, it said that the interest rate will be calculated on the repo rate plus 290 basis point spread on how it calculates its interest rate. But it did not clarify whether it will be charging a credit risk premium over and above this rate. But just looking at that amount, that's about 8.3% compared with 8.4% that the bank was charging earlier. So there again, the rates have come down. Things will change, however, for private sector banks who have largely been silent in the entire game so far as far as external benchmark linked rates are concerned. Here, we're looking at 2 of the larger private banks in the system, Axis as well as ICICI. In both these cases, as you can see, the effective revised rate is pretty much similar to what the previous rates were. So that is primarily because the banks have introduced a large spread over and above the repo rate. So that's about 345 to 390 for Axis Bank and about 350 to 380 basis points for ICICI Bank. While these banks did not clarify, what portion of this spread is because of administrative costs and what is because of credit risk premium, it suffices to say that the effective lending rate has not changed much, and therefore the banks will be trying to retain in that margin. Now remember, this is something that the analysts have been repeatedly pointing out, that as far as private sector banks are concerned, they'll be better at managing their margins than some of the public sector banks in the system. They don't mind sacrificing their margin as far as the lending activity and the borrowing activity in the system takes over again. The largest private sector bank in the system, HDFC Bank, has already clarified that large part of its book is actually fixed rate in nature, and therefore the RBI's new external benchmark linked rate will not apply to that bank. So that is where the entire lending system stands as far as external benchmarking is concerned.
All right, that's Vishwanath Nair with that report. Now, a couple of pieces of information that have just come out in the last 5 minutes. Firstly, from the Yes Bank con call, Rajat Monga has decided to quit and move on. So that's the erstwhile CFO who's been at that position now for a while. For the last many years that I can remember, dates back to X number of years that I can remember, it's been Rajat Monga who's been in that position, and he's now quit. It's, well, I don't know which way to look at it, but let's say if the stock, which way the stock reacts. Remember, just from a stock perspective today, as I said, it's also important to recognize that the selling pressure might be a bit lower compared to what happened on Tuesday, and therefore you just got to take that into account when you're looking to trade Yes Bank. This is not the best of news, yes, but let's see what happens to the stock in the session today. Just the other small piece of news that's just come on the exchanges, we'll put out on the flashes in moments from now as well, but Indiabulls Housing Finance has put out a notice that 1330 crores worth of masala bonds issued by the company have been pre-funded. They have pre-funded the entire maturity proceeds to Axis trustee 2 weeks in advance. So Indiabulls Housing Finance is trying to put up a brave face out here. Okay, moving on, the last piece on First Word today. Financial institutions with some exposure to the real estate sector were not spared on Tuesday. But curiously, the Nifty Realty Index is one of the best performing sectoral indices this year. Part of the reason could be attributed to the dominance of some of the bigger and financially stronger real estate developers, the most prominent of which will be Godrej Properties. The stock has outperformed the index by a mile this year. Sharad Dubey is here to tell us just why the Godrej Group has managed to do so well in an index which is also done reasonably well. Sharad.
Yeah, good morning, Neeraj. I think Godrej Properties is one of the key beneficiaries of the consolidation seen in this industry, post the ILFS crisis, and even the housing sector, which is grappling with a slowdown and an inventory pile-up. And if you just pull up the MRR chart, we see on a year-to-date basis, the company has, risen by more than 50%, while the Nifty Realty Index has risen by almost 6.8%, and other peers like Brigade Enterprises, Prestige, and even Phoenix Mills, they have all increased between 11 to 40%. Now, if we see this comparison, with the Realty Index and Godrej Properties, we see there's a huge, kind of a difference between them. As the last 5 years, the Nifty Realty Index has risen by almost 23%, but Godrej Properties, has been, the leader of the pack with 320% gain, almost 4 times its values we see, and each year it has, actually performed outperformed, for all the indices and also its peers. Now, we see the main reasons, the first one being the joint development projects, which the company undertakes. It's a unique kind of a business model. So whereas it doesn't actually, pay for the entire land, or it doesn't pay for the entire project, but it ties up with other developers. So this actually helps, the company to gain access to a good fund raising platform. And also, since the company is having a strong parentage, it actually helps company, raise capital, and also, they get it at a, competitive rates. So if you see the joint developments, from FY18 to almost Q1 FY20, it has almost increased, almost doubled, from 64 million square feet to almost 110 million square feet. Now, in terms of bookings value, you see the growth has been, going really nice, and the compounded growth has stood at almost 17% if you see compared to its peers like Brigade, Sobha, Oberoi, and Prestige, which ranged between minus 0.1% to 4%. Now, in terms of bookings, in terms of sales value, over the last 5 years, the bookings, the sales value has actually increased from Godrej Properties from 2,681 crores to almost 5,316 odd crores. That's almost doubling. This has been led mainly because of the 9 projects, which have come in the second half of FY19, which has actually pushed up the numbers. But while for other players, these numbers remain range bound. Now, lastly, we see the launches which have been coming in this, for the company, and this has been a steady increase, or going throughout from FY15, from 5 to it has increased to almost 16 in FY19, and 3 has already come for the first quarter this year. So that's almost 47 projects, or even more than that, they have come up over the last 5 years. And in order to look forward, you see for FY20, almost 11 more projects with almost 8 million square feet of space is lined up. So that is something which we will be watching out for. And Neeraj, one more thing I would like to add up, the brokerages are very, positive when it comes to the cash flows which will be generated from these joint venture projects. They are going to come in the next 2 to 3 years. So that is something which we will be looking out for, Neeraj.
Well, we'll certainly watch out for all of these. Sharad, thanks so much for putting that into perspective. So that's as far as Godrej Properties goes, and the reason why Godrej Properties is just doing so well. Remember, as I always say, some or most of the pieces that we discuss on First Word, stories around that are also there on our website. So some of the stories would be there on our website, BloombergQuint.com. Do log on and try and read more about this and all the other key stocks and news. The all you need to know copy as well on the website. So do try and log on and try and read about everything that you need to know to stay ahead in trade today. That's all that we have on First Word. Lots more lined up on Indian Open. We discuss markets and macros with Vetri Subramaniam of UTI AMC, a special chat with Pawan Goenka of M&M and Jim Farley of Ford about their joint venture, and how is CLSA valuing Indian equities. That's the big conversation. We speak to India strategist Mahesh Nandurkar. But after this break, a full tilt towards the day's trade.